Right now, there's a newly public tech company sitting on a massive, highly lucrative $40 billion AI infrastructure backlog. $40 billion. Yet, if you look at how Wall Street is currently pricing Nebius Group, it is completely struggling to understand the underlying economics of this business. Today, we are diving deep into this massive valuation disconnect. We're going to unpack exactly why the market is mispricing this AI infrastructure giant, what the financials actually look like under the hood, and what the real tension is that investors need to be paying attention to.
I really want to anchor our entire analysis in this shocking figure, $40 billion. This is the combined contracted value Nebius has secured from absolute heavyweights like Microsoft and Meta. Microsoft alone accounts for a $19.4 billion backlog, and Meta adds another $27 billion in total contract value. We are talking about guaranteed multi-year infrastructure demand. But if you just casually glance at their latest Q2 2026 earnings, you'll see a GAAP net loss of $190.4 million. You might just assume, oh, this is just another cash-burning tech stock. And honestly, that surface-level assumption is exactly why this company is worth such a close look today.
So, let's dive right into this. Why on earth is Wall Street ignoring a $40 billion backlog? The central conflict here is a fundamental misunderstanding between capital expenditures and true cash flow. The bear case is hyper-focused on the intense upfront costs of building out these massive data centers. They see the heavy non-cash depreciation hitting the income statement, and frankly, they get spooked. But as you'll see in just a minute, that heavy depreciation is actually obscuring a massive underlying cash generation engine.
To really understand the financials, we first need to understand the physical engine Nebius is building and the moat they've dug around it.
First off, Nebius isn't some startup that just appeared out of thin air. They actually spun out of the tech conglomerate Yandex in July of 2024, and they walked away with $2.5 billion in clean cash, zero debt, and a brain trust of over 1,000 highly skilled engineers. This brilliantly illustrates their true physical moat in an increasingly constrained market. See, your generic virtual cloud providers, often called neoclouds, they're mostly just leasing server space. They are entirely at the mercy of their landlords. Nebius takes a fundamentally different path. They own and co-design over 75% of their contracted data center capacity. This physical ownership completely insulates them from landlord lease escalations, it secures their long-term power delivery, and it heavily protects their margins as the AI infrastructure space inevitably matures.
So how do they actually stack up against a primary competitor, like, say, CoreWeave? Well, while CoreWeave has locked roughly 98% of its capacity into long-term fixed-price take-or-pay contracts, Nebius takes a much more dynamic and frankly lucrative approach. They balance their massive backlog commitments with highly profitable spot market capacity auctions. To put that in perspective, while a standard long-term contract might clear at around $12 million per megawatt, Nebius has been actively clearing short-term spot deals at premium rates of over $40 million per megawatt. They aren't just blindly locking in revenue, they are dynamically optimizing for maximum profitability.
And what's really fascinating here is their engineering advantage. Nebius operates at a power usage effectiveness, or PUE, of just 1.25. That is absolutely crushing the global data center industry average of 1.54. How do they actually pull that off? It comes back to that 15 years of engineering heritage, allowing them to work directly with manufacturers to co-design customized server chassis and liquid cooling distribution units. As they scale their massive 5.0 gigawatt contracted power pipeline across sites from New Jersey to Finland, this thermal efficiency translates directly into serious structural cost advantages.
Okay, so that's the physical infrastructure. Now let's look at the financial evidence that proves this aggressive strategy is actually working.
First, we need to break down where the money is actually coming from, looking at their Q2 2026 earnings, which were announced on August 12, 2026. Now, Nebius does own some interesting adjacent assets. They have the Avride autonomous driving unit, which happens to be backed by Uber, and Triple 10, which is an edtech bootcamp. They also hold a roughly 28% stake in ClickHouse, a database company valued at around $15 billion. But make no mistake about it, 98.7% of their top-line revenue is a pure-play bet on the Nebius AI cloud, renting out bare metal access to NVIDIA H200 and Blackwell GPUs. The absolute crucial point is right here in the Q2 2026 numbers. Consolidated revenues surged an incredible 454% year-over-year to $582.3 million, blowing past Wall Street expectations. Now, yes, there was that GAAP net loss of $190.4 million, which is driven by massive non-cash depreciation and interest on their convertible debt, but look at the operating cash flow.
It hit a staggering $2.25 billion. The core AI cloud segment achieved a near 50% adjusted EBITDA margin. On an adjusted basis, their EPS loss of 68 cents massively beat expectations. The market finally caught a glimpse of this cash engine, and it launched the stock price up over 34% in a single day to $259.20.
And by the way, if you like deep, evidence-based stock breakdowns like this explainer, make sure you're subscribed. Going back to that cash flow for a second, I want to highlight a brilliant strategic move that CFO Dato Alonso Sanchez emphasized on the earnings call. Nebius requires customer prepayments on about 70% of new deals. Those prepayments are projected to generate over $9 billion in upfront funding in 2026 alone. This is massive. It severely de-risks their $20 to $25 billion capital expenditure program because they are effectively using their customers' cash to build the data centers, drastically reducing the need for excessive dilutive equity raises.
Stepping back from the raw financials for a moment, let's synthesize the qualitative health of the business to see what's really holding it all together.
Based on the research scorecard, Nebius earns a blended score of 7.9 out of 10. Management alignment is incredibly strong here, with CEO Arkady Valaj holding an 11.5% stake. Revenue quality scores a very solid 9, secured almost entirely by that $40 billion backlog from Microsoft and Meta. Growth is a perfect 10, fueled by expanding data center footprints across both the US and Europe. Where they actually take a hit is on current GAAP profitability, scoring a 6, largely dragged down by $8.55 billion in convertible debt and that massive non-cash depreciation we discussed earlier.
All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders for quality businesses built to compound for years, hidden gems for under-the-radar names with asymmetric upside, and dividend hunters for durable income with the fundamentals to back it up. Portfolio Watch monitors your portfolio and flags important changes. Insider IQ tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this explainer. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. Now, before we look at where this could be heading, I need to clearly state, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. So let's move to the models and see how this builds out over a 5-year horizon, going from our 2026 base out to 2031. Factoring in their core AI cloud, their minority stakes in ClickHouse and Aviaride, and the state of their balance sheet, the probability-weighted valuation price target lands at $497.69. Given the current price of $259.20, this shows a highly asymmetric growth profile. Let's break down exactly what has to happen operationally for each of these 3 scenarios to unfold. In the low case, which we're assigning a 20% probability, we assume some serious operational headwinds. This means physical construction delays, utility connection bottlenecks, and intense GPU leasing competition that completely crushes their pricing power. In this scenario, revenue grows at a slower 30% CAGR to $11.88 billion in year 5. Net profit margins compress down to just 8%, which forces the company into dilutive equity issuances. Assigning a depressed 12 times PE multiple, the implied future share price collapses to $38.59. That is an annualized return of negative 31.68%. The base case, sitting at a 55% probability, assumes smooth execution. Contracted power builds are completed right on time, and that massive Microsoft and Meta backlog revenue is realized on schedule. Here, revenue grows at a robust 55% CAGR, reaching $29.52 billion. Scale efficiency pushes margins to a healthy 18%, generating over $5.3 billion in net income. Applying an 18 times PE multiple brings the share price up to $347.88 over the 5 years, which equates to about a 6% annualized return from today's elevated levels.
And then there's the high case with a 25% probability. This scenario assumes Nebius successfully transitions from a hardware leasing business into a high-margin enterprise software model. This happens if their Token Factory inference platform and their recent $400 million acquisition of Tavily, which is a search engine built specifically for AI agents, see massive global adoption.
In this bull scenario, revenue rockets at a 72% CAGR to over $51 billion. Software mix drives margins up to 25%. A premium 25 times PE multiple, coupled with a successful IPO of their ClickHouse stake, yields a massive 360% total return, putting the share price all the way at $1,194.56. And remember, if you want to access the full model with all detailed assumptions for each of these scenarios, you can check out the detailed research report over at flash.stocksentinel.ai.
But to keep this completely objective, we have to look at the real execution and macro risks. We have to give the bear case the respect it deserves.
What are the concrete threats that could actually break this thesis? Well, the single biggest physical execution risk is utility power grid connection bottlenecks. Specifically, they are building a massive 300-megawatt facility in Vineland, New Jersey. If regional grid operators delay environmental or utility permits, Nebius is going to miss their revenue targets and potentially lose their Microsoft backlog to faster competitors. Second is heavy concentration risk. Relying so heavily on just Microsoft and Meta means that if either of these tech giants reduce their infrastructure spending, or if they decide to aggressively build proprietary in-house silicon, Nebius could be left sitting on massive, completely unutilized data centers.
So what are the actionable, early warning signs you need to monitor? Watch the capacity auctions closely. If average clearing prices for their spot deals start falling below their $12 million per megawatt baseline contract rate, that is a glaring signal of a market oversupply in physical GPU capacity. Furthermore, if management delays confirming initial power delivery at that Vineland, New Jersey site past late 2026, you'll know for sure that their structural moat is starting to take on water.
Bringing this all together intellectually, there are 3 core takeaways you absolutely need to remember. First, the valuation disconnect. The market is hyper-focused on current gap losses caused by physical depreciation, and they are fundamentally discounting a $40 billion contracted backlog. Second, the software moat. Acquisitions like Tavily and EigenAI mean they aren't just renting hardware, they are vertically integrating model compilers, which creates massive switching costs for their customers. And third, physical asset protection. Owning over 75% of their data centers physically protects them from landlord evictions and secures their crucial long-term power supply.
Ultimately, resolving that curiosity gap we opened with, it all comes down to this. Can Nebius successfully convert $25 billion of massive upfront capital expenditures into recurring AI infrastructure dominance? The demand is contracted, the prepayments are definitely flowing, and the physical footprint is expanding fast. The tension revolves entirely around their ability to execute the physical build on time. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.